Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder from Seeking Alpha back with another episode of ETF Spotlight. In this one, we are diving into the world of airlines with none other than Frank Holmes. He is the CEO and CIO over at US Global Advisor, and we are talking about the JETS ETF, one that most of you are already familiar with, but we're going to dive into conversation here now with him. Frank, thank you so much for joining us today.
Great to be with you, Daniel.
I'd like to kick things off, if we can, with the creation of JETS and how the approach runs. Would you mind diving into the background and kind of give us a little bit of the formula underneath the package?
Well, I had to get into the ETF business, and so I'm a global investment company, and I was traveling all over the world, and I recognized my travel tickets had gone up substantially, and my options had dropped in 2014. So I said, well, what is an airline ETF? There used to be one called FAA, and that had shut down. And I said, I'm going to apply my quant approach and create this product called JETS. And it was to capture in a basket all the major airlines because they were all coming out of bankruptcy after the '08 crisis. And by 2015, it was amazing. Everyone was flying, and only Southwest had not gone bankrupt. And with that, I said something is very important here. And what we saw was this idea of using Smart Beta 2.0, which we basically took from Smart Beta and said we want to look at factors that are key for the construction of the portfolio, back test it. We had to use FactSet, because it was the most robust to go back over 10 years of data. Why 10 years of data? 40 quarters, 120 months. That allows you to do attribution analysis, looking at Q over Q and year over year data. You need at least 35 sets of data information to make something that's robust enough. So that was the magic of it, and it worked. And we said, okay, what do we want to beat? We want to beat the New York Stock Exchange Global Airline Index. And since then, we have done it. After fees, there's no fees on that index, but we have been able to do that. And it became the darling during COVID.
We do remember that. I remember when the announcement of Warren Buffett investing heavily in the airline sector during that time came out. And I think JETS ETF, I mean, you were talked about day in and day out during that time period as well. But focusing on this ETF, I mean, you have operators, manufacturers worldwide, you have the global airlines like you were talking about. And I mean, the top three of the holdings right now make up about, almost a third of the ETF. How do you think about when you're allocating the positioning across these companies around the world?
It's a great question. What we had found in our research was that the four major airlines captured 65% of all travel in America. So, but you can't have four stocks to be 65% of an ETF. So we had to sit back and say, how do I capture the majority of people flying? And so we had the big four airlines that would show up. Then after that, it became who has the strongest revenue per seat. So you can get out of FactSet the revenue per seat and the cost per seat. So you look at who's got the most seats and who has the most revenue per seat and who has the lowest cost per seat. And you can create a quant model for stock picking. And that's how the construction was. But the first, I would say 65% of the portfolio is really just airlines. And then it comes down to other parts that are key to the airline industry. And in that journey, we found all these airports. And airports function like private equity companies looking for a 15% CAGR, double their revenue every 5 years. And in Mexico, there were several airlines were listed on the New York Stock Exchange. Bangkok is public. De Gaulle in Paris is public. China's as a public airport. Japan as a public airport. So we said, well, let's make those international ones a smaller percentage. So therefore, we capped them at 1%. And what we found was that mitigated currency volatility, especially this year with the volatility of the dollar surging, dollar falling, dollar surging. That mathematical model based on this regressional study said this was the best mix, 20% foreign and 80% domestic.
That was going to be my next question. Actually, is how do you handle the currency? So all of the foreign holdings can only have a max of 1% within the ETF, correct?
Correct.
Frank, I'd love to ask you about this. So when people think about the airline industry, and traditionally I've heard from certain investors that, airlines are uninvestable is how they think about it because you can't control the jet fuel costs. You have these union workers that have to negotiate their contracts. There's all these things that people consider the risk of the industry. So is there anything that you can probably provide from your viewpoint being in the middle here of everything airlines? Are those overblown thoughts? Are they taken into the risk consideration when you think about the holdings in the ETF? What are your thoughts on all of that?
I think that they're all right risks. They're all correct in every category and every thematic idea has these embedded risks with it. But one of the big differences is that the airlines industry is so key for global economic activity. Southwest Airlines used to advertise that anytime they went into a new town or city in America, that business would go up 30%. So everyone was catering to get Southwest Airlines flying to small places in Kansas. It didn't matter. They just wanted to get flights coming and going. So I think if you really want to look for that growth in business, that's the airlines. We back up and we say, well, what are you paying for that? You're paying 1/3 the multiples of revenue for the S&P 500 and on a cash flow or earnings basis. So now we're seeing these stocks buying back their stock, increasing their dividend, and still trading at 5 times earnings. So I think it's been de-risked.
What about these, the other side of the airline sector now is they seem to be pretty integrated in with credit card companies and mileage programs and all these programs that people are also thinking from the investing standpoint of, well, that's kicking off a lot of revenue now. So are airlines still just really airlines, or should investors be thinking about them differently?
That's a great observation because I made that in 2015 of looking at the growth of ancillary revenue. And that ancillary revenue was started off with credit cards. And then the airline started charging you for changing your ticket, baggage you're putting on, what's the weight of your bag? All those ancillary fees grew just pre-COVID over $100 billion of this additional revenue. And so then it went away, and then they slowly now are coming back. So I think the idea of a captive audience using those credit cards, creating that loyalty program is important. Something else they've done is use AI to manage what used to happen in 2012, 13, 14 was lost baggage. And if the airline was delayed because of bad weather, it's annoying, it's frustrating, but you're not upset. You just, it's too bad, it's weather. But if they lose your bag, no, that's the airline's fault. So they invest a lot of money in AI and drop lost baggage by almost 90%. And now we're putting the AI into managing the flights and how they're managing all of their connections, etc. So I think they've really embraced technology at another level. And what we're really wrestling with, which hasn't gone away, is a shortage of pilots. The pilots used to come from the military, from the Air Force. Well, what's happened is that the Air Force now has all these pilots. They fly drones. They have no experience flying a jet. So they're not going to go from a fighter jet into a commercial airline because there's not that many pilots going through that program. So now they wrestle with, they can't actually go ahead and flood an area with these high fees they're making with more and more flights because there's a shortage of pilots, and it's not going away.
Yeah, I want to take it back to the ETF real quick because I want to make sure I ask you this question before we run out of time here. Is within the prospectus, it says you can either use a replication or a representative sampling strategy to track your index that you're going against. Can you explain just for a second why or when the fund might choose one of those over the other?
Well, we had in 2020, we had such an influx of funds coming in that, in fact, we were growing faster than the market cap of the airlines. I recall Warren Buffett capitulated in June of 2020, and airlines fell, but we brought in 100 million a day, and we had to deploy it. So all of a sudden, we then had to change and start looking at other airlines and expanding the footprint. So what we did globally is that we went from 1% to 0.5% to have more names, because we didn't want to be owning 15% of a bunch of names. That's how fast it grew. Then the airlines took off, and that right-sized itself. So quite often on M&A, big takeover, etc., we will look for a similar airline, such as JetBlue was trying to take over Spirit. So if we're out of Spirit, then we would go to take a look at a similar, like Frontier. That is how you would sort of take a look at the universe. But it's very dynamic, rules-based. And that's the important part. Is Smart Beta 2.0 is portfolio construction in addition to looking for the factors, and it uses mean reversion and then stock picking based on momentum, and it recalibrates every quarter. So sometimes between the quarters, you get these M&A dynamics, but they're really not material for the overall portfolio.
Now, I want to ask you one more question before we get on out of here. You had mentioned AI already, right? And I remember seeing across the headlines the other day, Delta's using AI for even pricing seats for individual people going forward. But thinking about the future of the aviation industry, what are you most excited about? Like, is it the new technology being introduced, the new aircraft being introduced, the fuel savings programs that they're trying to work on? What are you most focused on being so deep in this sector that investors need to keep top of mind?
Well, government policies are doing everything to print money to create jobs to keep the economy going, and the airlines industry now has tremendous pricing power. So they're going to be using AI to maximize the supply-demand factors, and that's what you're seeing. We started seeing flights from Phoenix down to Cabo St. Lucas during the COVID. And then all of a sudden they change their patterns of where they're flying. They're using AI. So they have the ability to manage supply, and the demand is only growing. And there's two big drivers for this. Is the psychology of COVID hasn't gone away, that people want to have an experience. And what we're seeing in Europe right now with record traffic going to Europe is Venice has made themselves more Disney World. We have this historic city, and you're going to have to pay 10 euros to be able to go to the inner part of the city. Barcelona is saying, yeah, well, we've got Gaudi and Picasso. And so now if you want to come here, you're going to have to pay a fee like you do at Disney World, because there's such pent-up demand and fear of being locked up again. And then you have the coders, there's strategists, consultants, and they're saying that I want to be a digital nomad, and if an American, I can make the first $120,000 tax-free, and I could turn around and go and live in Argentina in the winter. I can learn Spanish. I can do all my coding, and as long as I've got good Wi-Fi, I'm in good shape. That those numbers are huge, and they're going from South Korea and Japan, flying to Malaysia, Indonesia, to Vietnam during the winter. So we're seeing these demographic changes and psychological profiles that have changed, and I haven't seen it go away yet.
All right, Frank, let's go ahead and leave it there. Thank you so much for the time today. Everybody, Frank Holmes, CEO and CIO at US Global Advisors with the JETS ETF, talking to us here today. And we'll see you next week in another episode.
Wheels up.
ETF Spotlight. Wheels up. Thanks, Frank.